What if I told you that your biggest threat as a trader isn't the market, the news cycle, or even your trading system? It's your own mind. Deep inside your thought process lies a saboteur you rarely see coming: overconfidence. It doesn't scream or wave red flags. Instead, it whispers, "You've got this," when you don't. It convinces you that you see what others can't, that your instincts are sharper than the statistics, that you're the exception to the rule. Overconfidence is subtle. It doesn't start with reckless bets or oversized trades. It starts with small wins: a few well timed entries, a lucky short, a breakout that goes in your favor. These early victories become trophies your ego puts on display. You begin to believe you've cracked the code. And that belief, that's the trap. John Nofsinger in The Psychology of Investing highlights just how prevalent overconfidence is among investors. He cites numerous studies showing how average traders consistently overestimate their ability. One of the most striking findings is that individuals who rate their knowledge of financial markets highly are often the most prone to poor investment choices. Why? Because belief in skill replaces objective analysis. This isn't about stupidity, it's about human psychology. You're wired to seek patterns, to find cause and effect, even when there isn't any. When something goes right, your brain wants to assign it to your skill, not chance. And that's where overconfidence creeps in. You stop asking why something worked and start assuming it worked because of you. The silent saboteur grows stronger the more you feed it. Once you start believing that you knew it all along, you become blind to the randomness that drives markets. You underestimate volatility. You ignore your stops. You double down after a loss, convinced that this next one is due to win. But here's the truth: the market doesn't care about your confidence. It doesn't care how smart you are. And the moment you think you've tamed it, it humbles you. Hard. Ask yourself, how many times have you taken a trade not because the setup was right, but because you felt it would work? How often have you ignored data, journal entries, or even your own system because your gut told you otherwise? That's not intuition. That's overconfidence in disguise. Trading isn't about knowing what will happen next. It's about managing risk in a world of uncertainty. But overconfidence convinces you that uncertainty doesn't apply to you. It tells you that you're sharper, faster, more disciplined. And that's why it's so dangerous. It feels like strength when it's really just ego. In psychology, this is known as the better than average effect. Nofsinger explains how most people think they're above average in intelligence, honesty, and driving ability. The same goes for trading. But just like not everyone can be in the top 10%, not every trader who wins early is actually good. Think about that. If you're constantly winning but don't know exactly why, then you're not building a repeatable edge. You're just gambling. And gambling with overconfidence is a disaster waiting to happen. So what do you do about it? First, you recognize the enemy. Accept that overconfidence is a natural bias. It doesn't make you weak, it makes you human. But if you want to be a professional trader, you must think like one. Professionals don't assume they're right, they validate, they test, they track, they adapt. Second, you replace bravado with brutal honesty. Keep a journal. Track your trades. Write down why you took the trade, not just the technical reason, but the emotional one. Were you calm, rushed, angry? Overconfident? These patterns tell a story. Learn to read it. Finally, adopt the mindset that the market is your opponent, not your playground. It doesn't reward ego. It rewards discipline, patience, and consistency. Overconfidence may win the sprint, but it will never survive the marathon. As we continue, we'll explore just how deep this illusion goes and how to dismantle it before it dismantles you. You think you're better than most traders. You really do. And if you don't think that now, there's a good chance you have before. That's not arrogance. It's wiring. The research Nofsinger brings into focus is startling. Most people, including traders, consistently overrate their abilities. This isn't just a hunch. It's backed by years of psychological data. Think about it. When was the last time you said, "I'm probably below average at this"? You don't, especially not in trading. This game attracts competitive, intelligent, ambitious people who thrive on being exceptional. But statistically, not everyone can be. Someone has to be wrong. And in trading, being wrong means losing money. Nofsinger explains the classic study where people were asked to rate themselves in various areas: driving skill, intelligence, leadership. The vast majority rated themselves as above average. Traders are no different. But in the markets, this cognitive bias can be catastrophic. Because when you think you're more skilled than you are, you risk capital you shouldn't, ignore danger you shouldn't, and trust yourself more than the data says you deserve. You're not as skilled as you think. And that's okay, if you realize it in time. What makes trading so dangerous for the overconfident is that the feedback loop is broken. In most professions, if you mess up, you know it immediately. In trading, you can make a terrible decision and get rewarded. You shorted without a stop? It worked. You averaged down blindly? The market bounced, and now your brain thinks that behavior is valid. This is where Nofsinger's message hits hard. Skill is not measured by the outcome of one trade or 10. It's measured by whether you followed a repeatable process that gave you a statistical edge. Over time, discipline and process are the only truth tellers. If your success is tied to gut calls, intuition, or feeling the market, you're not trading, you're gambling. And if you're overconfident, you probably don't even realize it. Why is this so hard to admit? Because the trading world is flooded with bravado. Instagram screenshots of perfect entries, Twitter prophets calling tops and bottoms. Everyone wants to look like they've mastered the chaos. So you start believing that everyone else is killing it, except you. That pressure builds. You start to emulate the image instead of refining your edge. And this is exactly what the silent saboteur feeds on. It wants you to compare yourself to others. It wants you to chase performance, to confuse boldness with skill. Because as long as you're chasing, you're not thinking critically. You're not improving. You're simply reacting. Tendler in The Mental Game of Trading makes this distinction beautifully. He emphasizes that confidence built on results is fragile. Confidence must come from execution. Did you do what you were supposed to do? Did you respect your risk? That's the measure of real skill. Because results lie. Discipline doesn't. So, how do you confront the inflated self-image? Start by measuring everything. Journal every trade, your setup, your rationale, your emotional state, your adherence to rules, and the result. Then, look for patterns. Do your best trades align with your system or with moments when you broke it? This process strips away the illusion. It tells you the truth about your skill, not what you feel, but what actually happens. When you face this data with humility, something shifts. You stop playing the hero and start becoming the architect. And the irony is, this is where true confidence begins. Not in believing you're better than average, but in knowing what you're good at and what you're not. Confidence rooted in reality is unshakable, and it's the only kind that survives in the market. So ask yourself right now, are you skilled or just lucky lately? Are you a student of process or a prisoner of your own ego? The next section will dive deeper into another layer of self-deception, how feeling in control can be the most dangerous illusion of all. You think you're in control. You check the charts, read the news, set your alerts. You have your indicators aligned, your system in place, your risk defined. But underneath it all, there's a lie you may not even realize you've told yourself. That control equals certainty. That the tools you've assembled can bend the market to your will. This illusion is the next level of the silent saboteur, more deceptive, more dangerous. In the psychology of investing, Nofsinger introduces the illusion of control as the belief that you have more influence over outcomes than you actually do. Traders fall into this trap easily. You hit buy, and something in your mind tells you that action alone affects the market's future. That somehow, by clicking your mouse, you've initiated a result. But the market doesn't respond to your intentions. It doesn't owe you a bounce just because you planned it perfectly. Yet when things go your way, the illusion is reinforced. You chalk up a win, not to probabilities playing out, but to your timing, your feel, your skill. This is where the illusion becomes costly. Studies cited by Nofsinger show how this delusion can skew your decision-making. Traders who believe they're in control are more likely to take excessive risks, hold losers longer, and deviate from their systems. Why? Because they think their presence on the chart is what makes things happen. And when they're wrong, they double down. Not because of logic, but because they can't accept that they weren't in control to begin with. Let's break this down with something familiar. Have you ever moved your stop loss just a little further because you were convinced it would turn around? That's not logic. That's control illusion. The market didn't care where your stop was. It never does. But you convinced yourself that a better outcome could be forced by stubbornness. You tried to steer a ship with no wheel. This illusion becomes even stronger when you win after making a bad decision. That time, you broke your plan. And it worked? That time you ignored the news and still caught the move? Every one of those moments reinforces the idea that you control the market's behavior. And now your confidence rests not on the soundness of your system, but on the dangerous belief that you can bend probability. Mark Douglas warned us of this in Trading in the Zone. The market is a random distribution of wins and losses over time. Your job isn't to predict. Your job is to execute. Once the trade is live, you've already made your decision. The rest is out of your hands. But the illusion of control keeps you emotionally attached to the outcome. You stay glued to the screen. You react to every tick. You adjust exits, widen stops, chase missed entries. All of this comes from the fear of uncertainty. You think you're managing trades. What you're actually doing is avoiding the discomfort of letting go. This is where emotional discipline separates winners from losers. The elite traders, those who survive long-term, don't seek control. They build systems that work in chaos. They know that their edge plays out over time, not on this one trade. They don't need control to feel confident. They need consistency. So how do you escape this illusion? You start by embracing the randomness. You accept that no matter how good your setup looks, the market decides. Your role is preparation, not prediction. Build your plan, follow it without deviation, and detach emotionally once you're in the trade. The outcome is feedback, not identity. You also need to structure your risk so you can let go. If you're over-leveraged, of course you'll feel the need to control the trade. It's your money, your ego, your future. But if you size properly, you can sit back and watch like a scientist. This detachment is your edge. Remember, control is not certainty. It's preparation. You don't control outcomes. You control behavior. And that's enough. In the next part, we'll explore a paradox that fuels overconfidence. How winning, especially early on, can become your worst teacher. You win a few trades in a row. Suddenly, you're on top of the world. Everything clicks. Your setups feel intuitive. The market bends where you thought it would bend. You start telling yourself, I've figured it out. But that voice in your head, that's not mastery. That's the silent saboteur taking victory laps. Because here's the paradox. Sometimes winning is the worst thing that can happen to a developing trader. John Nofsinger emphasizes this trap in the psychology of investing. Early success inflates confidence, often unjustifiably. You start to believe that what you did caused the win, even if it was luck, even if your risk management was poor or your entry broke your own rules. The market rewarded bad behavior, and that creates a dangerous precedent. You now believe flawed execution is sound trading. This is how you become overconfident. Not because you're arrogant, but because your brain is wired to assume that good results confirm good decisions. Psychologists call this outcome bias. It's the tendency to judge the quality of a decision by its result, rather than the decision-making process itself. So you keep doing what got you the win, even if it's reckless. You stop analyzing your trades critically. Your system becomes more fluid, your risk more elastic. But eventually, the streak ends. The losses hit. And when they do, they feel like betrayal. You question everything because your belief system wasn't based on process, it was based on performance. This is the cost of winning too soon, too easily. It breeds illusions. It skips the grind. It tells you you're special, different, ahead of the curve. But the market has a way of exposing every lie you believe about yourself. And when that exposure comes, it's brutal. Think about the first time you doubled your account. How did it feel? Probably like validation, like proof that you belong. But did you stop to ask how you made that money? Was it through repeatable, systematic discipline? Or was it high-risk trades that happened to work? The difference is everything. Steve Burns once said, your first big win can ruin you more than your first big loss, because wins inflate expectations. You start to size up, take more trades, push the gas. But success without structure is dangerous. It's a recipe for burnout, financial ruin, and broken confidence. Compare that to a trader who builds slowly, who journals every trade, reviews performance weekly, respects stop losses. That trader may take longer to see big profits, but their foundation is strong. Their confidence is built not on luck, but on discipline. That's the kind of trader who survives. The key lesson here is simple but painful. Not all wins are good. If a win came from poor behavior, it's a loss in disguise. If you're not honest with yourself about the how, you're reinforcing bad habits. You're letting the saboteur run the show. This is why journaling is more important after a win than after a loss. After a loss, you naturally want to reflect. But after a win, your ego wants to celebrate. That's when you need the discipline to dig deeper. Did you follow your plan? Did you get lucky? Did you break rules but still come out ahead? This is where the real growth happens. When you stop treating wins as validation and start treating them as data points. When you evaluate how you played, not just how the market moved. And most importantly, when you learn to win the right way, not with oversized positions or random entries, but with clarity, control, and consistency. That's the win that matters. That's the one that builds careers. So the next time you hit a streak, take a breath. Don't ride the high blindly. Ask yourself, is my system working or is my ego celebrating? Coming up, we'll explore how this overconfidence begins to distort your perception of risk and what it costs you when it does. When you're overconfident, risk becomes invisible. You stop seeing it as a threat and start seeing it as an obstacle to profits. You no longer respect it. You manage it as an afterthought, something that can be handled once the trade moves. This distortion is one of the most destructive side effects of overconfidence. You become blind to the very force that can end your trading career in a single day. John Nofsinger illustrates this phenomenon in The Psychology of Investing by showing how overconfident investors consistently underestimate risk. They believe they have better information, better timing, better strategies. But belief doesn't equal reality. In fact, the more confident someone is, the more likely they are to misjudge the volatility and uncertainty in front of them. Why? Because when you feel like you're in control, your brain assumes the danger is less than it really is. This is known in psychology as optimism bias. You think the worst-case scenario won't happen to you. It's the same mental trick people use to justify speeding while driving or skipping a health check. They assume the stats don't apply to them. In trading, that optimism is deadly. You skip stop losses. You ignore your max drawdown limits. You trade through news events because you've done it before. You believe the market will reward your bravery. But risk doesn't care how bold you are. It only respects probability. This is where the real breakdown begins. You stop planning for downside. You become emotionally numb to loss. You might even start using pain as motivation, telling yourself you'll make it back on the next trade. This revenge mentality is a direct result of risk distortion. You're not managing capital, you're chasing validation. And let's be honest, how often have you said, it won't drop that far, or I'll get out before then, only to watch your position bleed past all reason? That's not strategy. That's illusion. And over time, these tiny lies build into massive drawdowns. What makes it even worse is the feedback loop. If you take a big risk and win, your brain locks it in as a viable strategy. You now associate outsized risk with outsized reward. You feel smart for trusting your gut. But you're not smarter. You're just lucky. And your risk tolerance becomes inflated beyond reason. This is the exact point where traders destroy their accounts. Think of a professional poker player. They don't go all in on every hand just because the last bluff worked. They understand the long game, the odds, the math. They fold more often than they play. Why? Because survival matters more than spectacle. Yet in trading, overconfidence flips that. You begin to seek spectacle, to prove something to yourself or others. But risk isn't meant to be proved against. It's meant to be respected. Brett Steenbarger, a performance coach to professional traders, talks often about the concept of emotional risk. It's not just about the dollars on the line. It's the psychological exposure. Are you risking your confidence, your process, your discipline? That kind of damage compounds just like a bad trade. And the more overconfident you become, the less you notice you're playing with that fire. To reverse this, you must reframe your relationship with risk. You need to stop seeing it as a barrier and start seeing it as the cost of doing business. Every dollar you risk must be accounted for, not just financially, but emotionally and cognitively. Start by lowering your size. Not because you're weak, but because you're wise. Small risk equals clear thinking. It allows you to follow your plan without panic. Track every drawdown, every stop loss hit, every time your plan saved you from a disaster you didn't see coming. That data grounds you. Overconfidence distorts risk perception, but discipline rebuilds it. In the next section, we'll explore how this mental distortion of overconfidence doesn't just affect your thinking, it affects your actions. Specifically, it makes you trade more, and more trades don't mean more success. They often mean more damage. You feel confident, so you act. And when you feel overly confident, you act even more. That's the behavioral loop that overconfidence creates, especially when it comes to trading volume. One of the clearest signs that your mindset is slipping into illusion is not in how much you risk, but in how often you trade. And this isn't just a hunch, it's a statistically validated effect Nofsinger brings to light in the psychology of investing. Overconfident traders trade more, period. They believe they see more opportunities, spot more edges, have greater insight. They think that their actions will be validated more often, so they take more swings. But as Nofsinger reveals, more trades do not correlate with better performance. In fact, the opposite is true. Studies have shown that higher trading volume is directly associated with lower net returns, especially among retail investors. Why? Because more trades usually mean more emotional decision-making, not more precision. The illusion of insight drives the illusion of opportunity. You believe you can outthink the market multiple times a day. You think, I can get in and out fast. The trend is clear. There's momentum here. But beneath each of those thoughts is the voice of the silent saboteur whispering, you're in control. You're not. Every trade you take requires emotional energy, mental bandwidth, and focus. And overconfidence tells you that those resources are unlimited. So you burn through them. You chase setups that don't exist. You revenge trade. You overanalyze signals that wouldn't pass your normal filter. And what happens? Your edge erodes. You mistake motion for progress. This is where the gambling trap begins. Ask yourself, when you're trading more than usual, is it because your system is firing on all cylinders, or because you're trying to feel something? Validation, significance, action? Overconfidence often wears the mask of high conviction, but what it really is fear. The fear of being wrong, the fear of missing out, the fear of sitting still, and the market punishes that fear. Think about professional traders. They don't place trades just to stay busy. They understand that inaction is as important as action. Some of the best traders in the world spend most of their time waiting. Why? Because patience is part of the process. They wait for high-quality setups with favorable conditions. They act with precision, not noise. But overconfidence flips this model. It makes you believe that you create opportunity through activity. So your charts are always on. Your entries become looser. Your risk gets wider. And every trade you take that doesn't follow your edge further conditions you to believe that activity equals skill. Tendler's concept of emotional volatility fits perfectly here. The more trades you take without discipline, the more volatile your mindset becomes. You go from calm to desperate, from focused to scattered, from confident to panicked. And when you're panicked, you make even more trades. It's a dangerous loop. So how do you break it? You first admit that your trading volume is a mirror. It reflects your mindset more than your edge. If your volume is climbing without data to justify it, you're not in control. You're being controlled. Review your journal. Track the number of trades per day or per week. Compare it with your profitability. More often than not, you'll see a direct inverse correlation. Then implement forced constraints. Limit your trades per day. Use alarms that block you from entering after 3 losses. Design a routine that values review time more than screen time. Shrink your watch list. Add friction to entry. These actions rewire your process away from impulse and toward intention. And most importantly, build comfort in not trading. Understand that not acting is still a decision, and often that's the best one. In the next part, we'll explore how this same overconfidence not only influences your actions, but rewires your memory. You start to remember your wins vividly and forget your losses entirely. That's not just dangerous, it's delusional. Word count. Do you remember your last big win? Of course you do. It's etched in your mind, the setup, the timing, the exact moment you clicked sell and watched the profit spike. Now, think about your last big loss. Not the small ones, but the painful one. Can you recall the details just as clearly? Or is it hazier, fuzzier, buried beneath excuses and justifications? That's not coincidence. That's selective memory. It's another weapon in the arsenal of the silent saboteur, an internal editing tool that erases pain, glorifies success, and quietly rewrites your trading story to keep your ego intact. John R. Nofsinger explores this in The Psychology of Investing, explaining how investors often forget or rationalize their failures while vividly remembering their wins. This isn't just a harmless quirk, it's a dangerous distortion. Because if you only remember what worked, you ignore what didn't. And if you ignore what didn't, you repeat it. Here's how it happens. Every time you lose, your brain rushes to protect your identity. It rewrites the narrative. The news changed. I had the right idea, just the wrong timing. Market makers hunted my stop. These explanations feel logical, even insightful, but they're not rooted in accountability. They're built to preserve your confidence. And over time, you build a mental database of cherry-picked truths. You remember the win where you nailed the breakout, but not the 10 failed breakouts that preceded it. You remember the lucky earnings play, but forget the one where you violated every rule and paid the price. This is how overconfidence thrives, on half-truths, misremembered trades, and convenient storytelling. This effect compounds with confirmation bias. You start to seek out information that validates your beliefs and ignore the rest. You read books that reinforce your strategy. You follow traders who think like you. You surround yourself with echoes of your own voice. And suddenly, your view of the market is no longer based on facts. It's based on filtered memories and tailored opinions. Tendler warns of this repeatedly. Trading performance must be measured in truth, not narrative. If your perception is biased, your improvement is impossible because growth demands pain. It requires you to stare directly at your mistakes, not blur them out. This is why honest journaling is non-negotiable. It's the antidote to selective memory. When you log your trades, the wins and the losses, and document your emotions, you create a mirror that doesn't lie. The more detailed your records, the harder it becomes to fool yourself. And you must go further. Not just recording the outcome, but your thought process. Why did you take the trade? What were you feeling? Did you follow your system? These are the questions that memory alone won't answer honestly, but your journal will. Another critical step is review. Set a day each week where you go back and analyze, not just charts, but you, your decisions, your behavior. Circle the trades that broke rules. Highlight the ones that followed your plan. Search for patterns. Do you lose more when you're emotional? Do you ignore stops after a win streak? Do you overtrade on Mondays? This is the kind of forensic analysis that builds resilience. It exposes the gaps between how you think you trade and how you actually trade. And when those illusions fall away, real progress begins. Selective memory feeds your ego, but self-honesty feeds your edge. Here's the truth. Great traders don't remember their wins more than their losses. They remember less because they write everything down. They trust the data more than their mind. They seek truth over comfort. That's how they grow. So ask yourself, how honest is your memory? How accurate is your story? Are you learning or just looping? In the next section, we'll explore how traders who let go of ego and embrace uncertainty are the ones who win, not through prediction, but through humility. You want to feel certain. You want to believe that if you just study more charts, analyze more patterns, and refine your system, you'll gain enough control to predict the market. But deep down, you know the truth. You can't predict it. The market isn't a puzzle to be solved. It's a storm to be navigated. And in that storm, humility, not prediction, is your most powerful asset. This is the pivot point most traders miss. Overconfidence tells you to dominate the market, but the best traders, they bow to it. They accept that uncertainty is the rule, not the exception. And because they accept it, they don't try to force outcomes. They adapt to them. John R. Nofsinger's insights make this clear. The illusion of control and the desire for certainty go hand in hand. You feel like you need to know what's going to happen next. So you overanalyze. You seek perfection. You tighten your grip on every trade. But the more you grip, the more you crack. Because this desire for certainty is fundamentally incompatible with how markets work. The best traders build flexibility, not forecasts. They work with probability, not certainty. They manage their mindset, not just their risk. They don't bet on being right. They bet on managing what happens when they're wrong. Take Mark Douglas's famous assertion from Trading in the Zone: anything can happen. That's not a cop-out. It's a foundation. When you believe that anything can happen, you stop needing to be right. You stop attaching your identity to outcomes, and suddenly you're free. Free to follow your plan without fear. Free to accept losses without emotional collapse. Free to respect the market instead of trying to conquer it. Humility is not weakness. It's awareness. It's knowing that the edge you've built only plays out over time and that no single trade defines you. It's knowing that even the best setups can fail and even the worst entries can succeed. And instead of resisting that randomness, you embrace it. Compare that to the overconfident trader. They can't lose gracefully. Every loss is a threat to their identity. Every red candle is an insult. They chase certainty like a drug, needing to be right to feel validated. But the market doesn't reward emotional dependence, it punishes it. Humility lets you detach. You start to realize that your job isn't to predict the next move. It's to manage risk, execute consistently, and trust the process. You don't need to know where the market is going. You just need to know what you will do in response. This is where elite mindset lives. Steve Burns, a trader and author known for his simplicity and discipline, talks about this mindset often. He doesn't care about being right. He cares about following his rules. If the trade fails, he exits. No drama. No story, no ego. That's the discipline that humility allows. So how do you develop this? First, you acknowledge that losses are normal. They are part of the system. You stop trying to avoid them and start learning from them. You embrace that trading is a game of edges and execution, not certainty and perfection. Second, you build your trading plan around contingencies. Not if I'm right, but if I'm wrong, here's what I do. You define exits, stops, risk, re-entry conditions. You create a structure that doesn't rely on guessing, but on reacting. Third, you celebrate process, not outcome. You reward yourself for following your plan, not just for booking green trades. You track your execution more than your profits. This is how humility becomes muscle memory. Humility is the antidote to overconfidence. It grounds you in truth. It protects your capital, your mind, and your future. In the next section, we'll break down exactly how to catch yourself in the act, how to spot overconfidence before it ruins your trade. Because awareness is the first step in taking back control. Overconfidence doesn't announce itself with flashing lights. It sneaks in quietly, disguised as confidence, intuition, or just one more trade. But if you learn to catch it early, if you build the awareness to spot its signs, you can disarm it before it sabotages your account. That's the key. Not eliminating it, but recognizing and controlling it. Nofsinger's research makes one thing very clear. Overconfidence is a pattern, not a moment. It creeps into your decisions gradually. One trade with too much size, one exit delayed too long, one loss you refuse to journal. These aren't accidents, they're signals, and the best traders treat them like red alerts. So how do you spot overconfidence before it does damage? First, notice changes in behavior. Are you clicking faster, ignoring your routine, taking trades outside your system, feeling invincible after a win streak? These are psychological tells. Overconfidence doesn't feel like recklessness. It feels like being on fire. That's why it's so seductive. But being on fire is usually just the ego stretching its legs. Second, track impulsivity. Did you size up without a reason? Skip a checklist step? Trade during market chop even though your rules say not to? Overconfidence creates urgency, a feeling that you must act, that this setup can't be missed. When you feel that internal push, stop, breathe. That urgency is a lie. Third, check your emotional reactions. Do you feel angry after a loss? Euphoric after a win? Are you more emotionally reactive than usual? Overconfidence increases emotional volatility. Your highs get higher, your lows more destructive, and both lead to worse decisions. That's why trading when you're overconfident is like steering a car blindfolded. You think you're in control, but you're not seeing the road. Fourth, look for rule breaking. That one tiny deviation you call a judgment call? That's how overconfidence starts. And the moment you rationalize it, I know what I'm doing, it'll bounce, I've done this before, you're already compromised. The only thing worse than breaking your plan is justifying it. But awareness alone isn't enough. You need systems to keep you accountable. Start with routine. Before every session, review your rules. Out loud. Yes, even if you've memorized them. This creates a moment of grounding, a reset button. Then, after every trade, rate yourself. Not on the outcome, but on your execution. Did you follow your system? Was your mind calm? Were you in sync with your process? Next, use journaling not just to track trades, but to track confidence. Each day, rate your emotional state before and after the session. Watch how changes in emotion correlate with changes in behavior. When confidence starts turning into overconfidence, you'll see it in the data. Then implement stop mechanisms. If you hit a loss limit, walk away. No questions. No revenge trades. If you break a rule, take a forced break. These penalties don't make you weak. They keep your future self safe. They're the guardrails that stop your silent saboteur from driving you off a cliff. Finally, find external accountability, a coach, a trading group, a partner who knows your plan. Sometimes you need someone else to call out your blind spots, because when you're overconfident, you are the least qualified person to assess your risk. This is where the elites separate from the rest. They don't avoid overconfidence. They anticipate it. They study it. They build systems that assume they'll drift and then pull them back. This is real professionalism. Not just mastering the chart, but mastering the self. Because here's the truth. You can't eliminate your biases, but you can outsmart them. And that's how you win long term. Not by being flawless, but by being ruthlessly self-aware. In our final part, we'll put it all together. You'll learn what the most disciplined traders do differently, how they train their minds to see through illusion and operate from clarity every single day. You've seen the signs. You've felt the effects. Overconfidence is no longer invisible. It's been exposed. Now comes the most critical piece of all, building the mindset that protects you from yourself. Because elite trading isn't about beating the market, it's about mastering your discipline when your mind tries to betray you. In The Psychology of Investing, John Nofsinger paints a clear picture. Most investors fail not because of external conditions, but because of internal misjudgments. The illusion of control, the belief in superior skill, the failure to remember losses, these all boil down to a lack of self-awareness. The silent saboteur lives in your mind, and your job now is to shut it down. So what do the best traders actually do? They build systems around their psychology, not just their strategies. They don't rely on willpower. They rely on structure. Their rules aren't casual, they're sacred. And they don't just study charts, they study themselves. Start by designing a system that removes discretion. You want to eliminate as many on-the-fly decisions as possible. Your entry, exit, and risk parameters should be defined before the market opens. If your strategy requires intuition, you're building on sand. If your rules are optional, you're leaving the door wide open for the saboteur. Next, integrate emotional checkpoints into your process. Rate your emotional state before trading. Write down your thoughts. Check for urgency, excitement, or pressure. If anything feels off, delay your start. Elite traders don't force the game. They wait until their mind is in alignment with their process. Then, create accountability. Whether it's a mentor, a peer, or a community, someone must know your system. Share your journal. Talk through your mistakes. Give someone else permission to call you out. Alone, your ego can run wild, but in the presence of a truth teller, it has nowhere to hide. Most importantly, detach your identity from your results. You are not your P&L. You are not your last trade. Your value as a trader is determined by the quality of your process, not the size of your wins. That's how elite traders stay calm in chaos. They don't need a green day to feel successful. They need discipline. Jared Tendler talks about corrections at the emotional level. It's not enough to change your behavior. You have to rewire the beliefs underneath. If you believe success means being right, you'll always overtrade and overreact. But if you define success as following my process, then every trade becomes a chance to win, regardless of outcome. That's how you stay grounded. This work isn't easy. It requires reflection, structure, and repetition. But the results speak for themselves. Traders who master this discipline last longer, recover faster, and grow deeper. They no longer seek to control the market, they control themselves. So, here's your final task. Start today. Build your system. Track your patterns. Rate your mindset. Create guardrails. And most of all, Stay humble. You now know what the silent saboteur looks like. You've seen the mask of confidence that hides ego. You've felt the lure of control and the price of illusion. And you understand what elite traders actually do to win. They aren't fearless, they're aware. They aren't perfect, they're disciplined. In the end, this is the real edge. Self-mastery. Now go build it. Overconfidence is not just a flaw, it's a threat. It sneaks into your trades, distorts your memory, pushes your risk tolerance, and convinces you that discipline is optional. Through John Nofsinger's The Psychology of Investing, we've unmasked this silent saboteur. You've seen how it creates illusions of control, fuels overtrading, and rewrites losses into false narratives of skill. But you've also seen the antidote: self-awareness, journaling, humility, process over outcome, structure over spontaneity. The elite trader doesn't avoid uncertainty, they embrace it. They don't seek to conquer the market, they learn to coexist with it through discipline and reflection. That's the lesson from this journey. You've been given the map. Now, take action. Start by reviewing your last 20 trades. Where did ego interfere? Rebuild your checklist. Define rules that protect you from yourself. Track your confidence daily, not just your equity. Revisit this breakdown when overconfidence begins to whisper again. Your edge is not your setup. Your edge is your self-control. If this deep dive helped you recognize your blind spots, helped you feel seen in the struggle, or reminded you why trading is an emotional game, then do this. Like, comment, and subscribe. Share it with a trader who needs this wake-up call. Help them break free of the illusion and find their edge, just like you.